So once again, Webbot told you a good bit in advance to watch that real estate market. Watch the high-end real estate first, and then watch normal real estate. The markets, those two markets are going to tank. High-end real estate and then normal real estate. They will tank, starting with high-end real estate. I've read you at least 2, maybe 3 times now, some instances of some high-end real estate diving huge numbers. Zero Hedge posted today. Well, today's the 27th. You'll see this tomorrow. This one is very surprising. Zero Hedge, Tyler Durden. Well, I know that's his little fictitious name. This one's not very surprising. Why? Because I got a Webbot report in my pocket, and the other hand's giving a high five. This one is very surprising. U.S. luxury rental market turmoiling as EQR cuts guidance for a third freaking time. Back on April 27th, Chicago-based real estate investment trust Equity Residential, or EQR, lowered its guidance during its quarter one earnings call, expecting a drop in revenue growth to 5% due to a luxury apartment slowdown in Manhattan. The landlord said at the time that New York City just turned very quickly and more deeply than we expected. In other words, the market turned unexpectedly. There's some crazy stuff going on in New York, he said. Then in early June, for the second time in less than 2 months, the landlord unexpectedly cut its earnings growth estimates once again, saying that the low end of the previously revised guidance of 4.5% to 5% has now become the high end of the range, as EQR forecasts revenue growth of 4% to maybe 4.5%. Quote, the revision is being driven by continued weakness in its New York portfolio and recent underperformance in the company's San Francisco portfolio. New lease rates are not meeting original projections due to new rental apartment supply, the company said in a statement. The revision is being driven by continued weakness in its New York portfolio and recent underperformance in the company's San Francisco portfolio. The new lease rates are not meeting original projections due to new apartment rental supply, the company said in a statement. Oh, that's the reason. You just have to have some reason. Gotcha. As we commented 2 months ago, what's notable in the new guidance from EQR is that San Francisco has now joined the party, a development that clearly caught COO David Santee off guard. To be sure, the unexpected. It was very expected. Mr. COO, I'm quite certain you make a tiny bit more than me. If you want to switch jobs, I'll set the record straight over there. I won't be telling the CEO and anyone else, shareholders, that it was unexpected. Actually, listen to me, ladies and gentlemen, it's very expected. I've got this chart from Martin Armstrong. Goes out to 2033. His charts are second to none with his wave theories and stuff. And there's an alignment with the real estate market. And it's kind of saying that real estate from this point forward, actually late last year going forward, not looking good for the next 16 years. But then again, people would flee, investors, shareholders, they'd be out, and then I'd be out of a job. So what would I do? Well, I would lose all morals and lie to them. Tell them the market's great. What about the fact that your forecast of 5% is now 4 to 4.5? Just new apartment competition. Nothing to worry about. It'll go over. You know, like a storm cloud, it'll blow over. It'll be fine. Okay, all right. I guess I'll keep my money in. And then I'd throw up in the bathroom because I just lied to everyone's face. I'd be sick to my stomach. The surprising deterioration in what, until recently, have been the 2 most stable rental markets in the U.S. shocked analysts. This one is very surprising to us from What we view to be a top-tier organization with the sophisticated infrastructure that usually communicates future performance within a relatively visible band, Mizuho Securities USA Inc. analyst Hendel St. Just and Richard Anderson wrote in a note to investors late Tuesday after Equity Residential's announcement. The implication is that the future performance is not that visible after all. The analysts cut their recommendation on Equity Residential shares to underperform from neutral. The shares were also downgraded by analysts at BMO Capital Markets Corp., who lowered their rating to market perform from outperform. The stock price drop, it was the biggest intraday decline since March 1st and the most in the 15-company Bloomberg Apartment REIT Index, which fell 3% in sympathy. Oh, so a market falls in sympathy. So a market is alive and has feelings. That's funny because the Congress and the Supreme Court didn't change laws that made it like that, like they did with corporations. Corporations are now considered people. Remember that one? So now you can give unlimited funds to your favorite politician. Corporations are now considered people, ruled upon. Yep. So I guess it's not too far of a stretch of imagination to say that markets are people too. After all, they have feelings. The index, the REIT index, fell 3% in sympathy. Avalon Bay Communities Inc. and UDR Inc., which both reported earnings this week, were down more than 3%. We were already surprised by the lack of visibility into the outlook after two reductions in 2016, St. Just and Anderson wrote. The third is too much for the market to handle. Too hot to handle, too cold to hold, I guess, huh? As Bloomberg adds, Equity Residential is among landlords having to work harder to lure tenants in the high-cost markets of Manhattan and San Francisco, as an apartment construction surge gives residents more bargaining power and limits how much owners can raise rates. Quantifying how weak the rental market has suddenly become, Avalon Bay gave renters lease signing concessions worth $300,000 in the second quarter, 4 times more than in the same period a year earlier. Chief Operating Officer Sean Breslin said on the company's earnings call Tuesday, the sweeteners in the form of free months of rent were greatest in New York, Northern California, and New England. Let's give out several free months of rent. Let's give out 1 free month of rent. Oh, that's not working. Now let's give out 2. Okay, now let's try 3. Soon you're going to have a whole year rent free? Just, start paying next year. Oh, you know what? Our year, you bozos gave me a year lease and you gave me a free year for free. I'm not renewing my lease. Have a nice day. Wouldn't that be fantastic to read about? Markets do reset from time to time, either due to new supply or changes on the demand side of the equation. Equity Residential Chief Executive Officer David J. Nethercutt said Wednesday on a conference call to discuss earnings. Unfortunately, at the present time, we're experiencing both factors in 2 of our most important markets. So you're saying sometimes markets reset from time to time due to one of 2 things: new supply or changes on the demand side. That's a nice way to put it. Demand changes, it changes on the demand side. Correct. As in, I can't afford this high-end crap. Can't afford it. Oh, then I guess we have to lower our prices. Yeah. Sorry about that. Other REITs did not fare better. Avalon Bay cut the midpoint of its full-year forecast for same-store revenue growth by 0.4 percentage points. Job growth in the markets where the company owns apartments was also weaker than it expected. Unexpectedly, there it is, in the second quarter, damping demand for rentals in what is usually the busiest leasing period, Breslin said. We did not see the same seasonal lift we've seen in prior years. Avalon Bay Chief Executive Officer Timothy Naughton said on the company's call. In San Francisco, about 5,100 new units, the most in 26 years, are expected to be listed for rent in 2016. Data from research firm REIS Inc. shows. In Manhattan, 5,675 apartments will be added to the rental inventory, most of it high-end, according to brokerage City Habitas. Making matters worse, spent-up supply will only pressure prices more in the coming months. Many of this year's new apartment buildings in New York will still be seeking tenants in 2017, and Equity Residential is concerned that competing landlords will start offering more concessions to would-be renters in the final quarter of the year, Santee said. Equity Residential is projecting that New York will get 14,000 new units in 2017 and another 14,000 the following year. Santee said on the call, "You make the call. About 7,000 units will be added in San Francisco next year," he said. For those who still assume that U.S. high-paying jobs are doing just fine, the following disclosure from EQR will be disturbing. San Francisco and New York, which account for half of Equity Residential's projected revenue growth, are seeing a slowdown in hiring for jobs that pay enough to enable renters to afford the new luxury apartment supply coming in those cities. Chief Operating Officer David Santee said on the call. High-salary technology jobs in San Francisco peaked in the first quarter, while in New York, the biggest employment gains this year were actually in hospitality, leisure, and healthcare, which are mid-level compensation industries, he said. This means that the minimum wage recovery has now spread to the cities which traditionally are the highest-paying ones. It also means that any hopes for substantial wage growth, aside from mandatory minimum wage increases, can be thrown out of the window. That this will have a substantial impact on Fed policy goes without saying. That is a Big 10-4, good buddy. Webbot will absolutely nail this one. It already has. Take care.